There's a lot of different definitions of what a cap rate is. This is kind of the best one that I kind of relate to. It's the rate of return generated by a real estate investment property based on the annual, it's critical, net operating income, right, that a property generates. Let me give you an example, and this is kind of simple. We talked about if we pay cash for a building, right? The NOI is critical for a lot of different reasons. If we paid $1 million for a building, right? So say it's a 20-unit building, however many units, it's $1 million. If we come in and we pay that $1 million, we had a big windfall, won a lot, whatever. We paid $1 million, right? So there's no mortgage. The net operating income on an annual basis, let's just say, is $100,000. So we paid $1 million, got $100,000 net operating income, right? So if I paid $1 million, in that year I could put $100,000 in my pocket, what was my rate of return on that $1 million? 10%, right? That's my capitalization. I got a 10% capital, okay? I got that property generated if I pay cash, 10% on the cash, all right? Here's a formula, okay? Cap rate equals the net operating income divided by the purchase price. So if I had $100,000 and I divided by that $1 million, 10% cap rate, okay? It's that simple. It took me, when I first learned it took me a couple of months to really get my arms around it. So we're here in an hour-long presentation all together. So you may not grasp it, you may know it like the back of your hand. Understand it's very, very important. And it simply is the rate of return you would get on an annual basis if you pay cash for the building. All right, let's go to the next one. I'll go a little bit more into detail about it. Here, I just said that, but here it is again. 10% cap rate is $100,000 NOI, $1 million price. Now, you mentioned a 5 cap. I'm gonna, at the end of the presentation, I always show properties. We want to not just talk philosophy, we also want to talk, deals. I'm going to show you a couple of properties. One's going to be a 5 cap rate, one's going to be a 9 cap rate. And you'll see why when I show it to you. Just know that they vary widely, and it represents the rate of return you will get on an annual basis if you pay cash for a building. There's probably about 10 or 20 different definitions of it, but that's the simplest way that I came to understand it, and I like to convey to you guys. So that's critical. Here's a quick thing. The higher, the better when you buy. So when you're buying something, you want that cap rate to be higher, right? When you sell it, you want it to be lower, all right? Cap rate oftentimes is a factor of the marketplace. I'm not going to go into the marketplace or economics and all that stuff, but interest rates, tax rates, cost of capital, all these things factor into what a market cap rate is, okay? There's very little things we can do as investors to affect the cap rate. There are a couple things, and a couple things we can do is improving the physicality of the property. If you look at a beat down, run down building in the same neighborhood versus a newly built building, let's say if you got the beat down building on this side of the street, and on the other side of the street you got the brand new building. That brand new building, the cap rate is going to be a little bit lower, probably a lot lower than the cap rate on that beat up building. That is going to be a higher cap rate, because if you're going to pay cash for that building, looking at it, if you're paying cash, right, and you got a beat up building, you need to get paid more for that, because there's more headaches, you're going to have to put more money into it, it's going to be more difficult to deal with, it's going to break down more. If you got a brand new building, less headaches, less maintenance, less things to deal with, so you can get a little bit less money, because the trade-off is I'm not going to be having to have all the headaches of that old building that's beat up, okay? So just keep that in mind. Very